So obviously we're all just going to be trying to work with this new transition into online learning. To be quite frank, I'm not exactly sure how it's all going to play out, and there might be changes coming soon, but this is the shot that we're giving it this week. And we're going to be recording all the sessions. Actually, let me record this. I don't. Oh, I'm the co-host. Yeah, so basically the way that this is going to work now, since we've transitioned into online learning, is we're hoping to hold these sessions still Tuesdays 2 to 3:30 via Zoom, so you guys can pitch like regular. You're just going to share your screen with your decks, proceed as usual, and then we're going to send out these recordings to all the general body, and then there'll be like a passcode at the end so people can vote on the stocks, but the hope is like that they watch the video first before voting. And we're not going to do news because I'm just going to send those out as articles, because I don't think anybody wants to like listen to me talk about news, unless you guys do and want to talk about
That's all we want, Yasmin.
that. Or if you guys have heard anything and you do want to share, feel free to speak. Okay, yeah. All right, so let's begin with Starbucks. So you guys
Ben,
can just
can you share your screen, Ben?
I'd love to share my screen, Cam.
Okay. Yeah.
All right. Let's try this.
Just click.
Do you guys see like the presentation? Oh, okay. I see what you. Do you guys
you're
see
good.
the presentation or okay?
Yeah, you're sharing now. We can see it. You're good.
Go to the first slide, though.
Right. Yeah. Hello, everyone. Cam and I did Starbucks for our first consumers pitch. If you don't know, I'm Ben.
I'm Cam.
All right, cool. We can get started here. So we're just going to do the typical rundown, our investment thesis, our industry overview, company analysis, ESG integration, and then the evaluation. So first off, the investment thesis, Cam.
Yeah, so this is just an overall slide. Basically the idea that we obviously the big thing going on in the news is coronavirus, and there's been obviously a massive sell-off in the market since because of that news. And we think Starbucks is a decent company for us to look into now. We kind of focus on companies that were, pretty solid brands that are going to maintain sales through a recession, because we do see a recession incoming. And they're also pretty well positioned to kind of mitigate some of their risks. So we recommend Starbucks at a buy of $65. The current price is a little bit above that. Actually, I think that was a couple of days ago, but
that's as of like 2 minutes ago.
Okay, perfect.
65 was just our like ballpark number, because obviously it's been pretty volatile.
Right. And then we see a price target of $90.95, a 1-year price target with 35% upside. And then just some rundown of some ESG factors that we'll talk about more throughout our presentation, specific to Starbucks. They have great governance. They're issuing sustainability bonds. They're transitioning to reusable cups, incentivizing customers to use those, completely transitioning to strawless. They're supposed to do it by 2020, but I've heard otherwise, that they're kind of still transitioning. And then they have this CAFE, CAFE, sustainable sourcing kind of guidelines that they follow pretty stringently. I went through the document myself, and I didn't go into too much detail in the presentation just because it's a lot, but it's very, very stringent, and they focus a lot on that in terms of their sourcing. We'll talk a little bit more about that. Some catalysts that we saw is kind of harkening back to the incoming recession. They're an industry leader, and people need coffee in recessions, so they should be okay in terms of weathering that storm. And their balance sheet's pretty strong, so that in terms of a recession incoming, they should be okay there. They're actually expanding in China. They were set to open a bunch of new stores in China, but obviously coronavirus put a bit of a halt on that, so they had to kind of slow down their expansion in China. But I see that as a bit of a catalyst, actually, because China is recovering faster than the rest of the world economically in terms of the coronavirus spread. That they obviously, that was where it started. So their recovery is going to be sooner. So maybe that can offset some of the lost sales elsewhere. They're also partnering with Uber Eats to offer delivery, which is pretty new and kind of unique for a coffee chain. And obviously that's delivery in the next 12 months is probably going to be a pretty big focus for them. So that's good that they did that. That's a pretty recent partnership. And then another thing that we saw as a catalyst, this may change if, you know, depending on the deepness of the recession, but they're capitalizing on experiential retail, opening up high-end retail stores, which we'll talk a little bit more about. And then some risks that we see is obviously recession, decrease in consumer spending, discretionary spending. Some people may view Starbucks as discretionary spending, may transition to at-home brewing, things like that. The risk, you know, the value of their brand is really, you know, allows them to charge higher margins. So if that decreases, then that could impact, you know, their bottom line. And then coronavirus obviously is a pretty macro risk. And then oversaturation is a pretty important risk for them. They're obviously Starbucks in urban areas like New York City, Boston, other cities in the US and globally are on every block. And so that can kind of cannibalize certain same store sales, but they're trying to mitigate that, as we'll talk about a little bit more.
Yeah. So now going into the industry outlook, the industry trends, coffee is like, I guess more or less it's a commodity. People who drink coffee drink it every day, but there's kind of a rise in like making specialty coffee, specifically with cold brew and alternative brewing methods. So it's kind of like making coffee a specialty or like something greater than it is in a way. And then furthermore, there's a rise of pre-ordering. So like on the app to go orders, drive-throughs. I mean, drive-throughs have been around, but certainly the app ordering has been big, and right now especially. And then kind of alternatively, or like in the other direction, coffee shops have become a place to like hang out, do work. Starbucks isn't like a Dunkin' Donuts where you just walk in, you grab your coffee and leave. It's more of a place where you could, you know, grab your coffee, sit down, you know, drink your coffee and read the New York Times or do your, you know, whatever work. So that's kind of a unique aspect of the company that defines itself maybe against its competitors. Not Pete's is similar, but Pete's also doesn't have as much of a retail presence as Starbucks does. The other thing is kind of growth in take-home options, K-Cups, Nespresso, and traditional bagged coffee. There is some growth there, but I will say that in terms of like their revenue, it's only 8% of their total revenue, mainly because net income, because their margins on you know, bagged coffee are significantly lower than a cup of coffee. I mean, you can charge like a medium hot coffee at Starbucks for $3.50 and a bag of coffee, which could give you like, I don't even know, 25 cups of coffee would cost $10. So clearly the margins are not as great. And then lastly, there's kind of a transition towards healthier, less sugary options. So away from frappuccinos, which is like the Starbucks frap version of coffee, to just healthier options. In terms of ESG material factors, specifically with coffee, they look at responsible coffee producers, and like furthermore, responsible management of those employees. So making sure that, you know, the labor practices of these growers are good. Furthermore, like supply chain, coffee stores are very reliant on producers in South America and other parts of the world. So they're reliant on supply chain and trade in general. Yeah, like ecological impacts kind of goes along with that. Responsible coffee producers and making sure that their producers are doing responsible things. And then also, I guess, would be like the whole no straw and reusable cups, which has been placed on hold because of COVID-19. And so kind of like growth outlooks, Ibis World projected a 2.3% annual growth as a whole for coffee. And then the increased growth overseas, and specifically in China, The FT released an article in mid-February regarding kind of the growth of coffee in China, and the people in China typically don't drink coffee; they drink tea. However, the stat was even like six. Like the average person in China drinks 6 cups of coffee a year. But Starbucks is looking not only into like getting into business districts that have more international presence, but they're also looking to actually selling more tea products and really trying to market specific to those consumers. Millennials, I guess, tend to have an addiction to coffee and tendency to work in coffee shops. That was kind of like a Forbes article, but I think there's probably something to that. Growth in terms of pre-order, which we already talked about. And then this is something that I think is kind of hidden, and Professor Ullman kind of got me on this idea. He mentioned it a couple times in class and I looked it up. But Starbucks historically shifts around prices as the market shifts. So they'll very, very like quietly raise their price 20 cents or bring it down 20 cents, depending on how they feel people are spending, and therefore, and they'll maximize their margins that way. So.
All right, then we'll just jump into the company overview. So the business overview, obviously Starbucks trades on the NASDAQ with the ticker symbol SBUX, SBUX. It was founded in 1971 by Howard Schultz in Seattle. And he was the former CEO to Kevin Johnson, down at the bottom there of the slide. Kevin's the current CEO. He was actually handpicked by Schultz to be his successor once Schultz realized he wanted to retire. So we know the company's in good hands, and I listened to a couple of his calls on CNBC, and he definitely is kind of steering the ship in the right direction. And then in terms of Starbucks market share, they have about 40% of the U.S. coffee shop market, depending on what metrics you look at. So obviously a very high number. They're the largest coffee shop, I guess, chain, as we probably all know, in the U.S. So they're definitely widespread for sure. They have 8,000 stores in the U.S. and 15,000 worldwide. Then you can just see their stock performance over the past 52 weeks. They're significantly down off their high of about $100. So it should be a decent buying opportunity for us. And then some of their ESG efforts. Starbucks has 1,500 LEED certified stores, and they want to make all North American stores 100% renewable energy. That's a current goal of theirs. They also conduct anti-bias training with 175,000 of their retail employees, their baristas and whatnot, every year. And that was because of an incident we probably all kind of heard of a few years ago. And they've had other incidents as well, but they took steps to improve that for sure. And then they also incentivize reusable cups, and they're transitioning to straw-less, as I already mentioned, as well as their sustainable sourcing efforts. All right, so some risks. I kind of already talked a little bit about oversaturation, but yeah, so basically they have a lot of stores everywhere, and so sometimes that can cannibalize certain store sales, like opening up a new store too close to another one will cannibalize that previous store sales. So while they may be opening a lot of new stores, that doesn't necessarily mean increased sales. So what they're kind of doing to mitigate that is specifically in urban areas where there is large risk of oversaturation, they're taking a very pointed look at what stores are opening, where they're opening new stores, and also kind of assessing current store sales and whether or not they can close stores. So they can really only do this with company-owned stores, but they're strategically closing. And Starbucks owns about 52% of its stores. Like the company owns them; they're not franchises. So they can do that with those stores, and they do that on a regular basis, just kind of a rolling basis. Whenever the numbers kind of add up for them, they strategically close stores to basically cut the dead weight. And then another risk, obviously, the coronavirus economic shutdown, basically globally at this point. So one thing that is good to note about Starbucks, they have a strong balance sheet. Their cash reserves are pretty solid. They are actually operational somewhat, obviously in reduced capacity. There, no one's going in stores in the U.S. and most, and definitely in Europe. They started to open up stores in China a bit, but their drive-throughs are open in the U.S., North America, and delivery is up as well through Uber Eats. So they're at least getting some revenue through, and they are also paying their workers through the coronavirus shutdown, despite some workers not coming to work, whether or not the store's closed, they're still paying them. So that's a good ESG metric as well. And the other thing I kind of mentioned before is the recession, impending recession could cause a transition to more home brewing as people kind of try to cut spending somewhat. So obviously margins will be less if this does happen, and Starbucks is still selling coffee as it is going to. People are going to still buy coffee from Starbucks that might be in a bag form or in Nespresso or K-Cups or whatever. So the margins are going to be lower, but at least there's still, it's not a complete shutdown of their revenues. The other thing, they're also changing consumer patterns could change as a result of coronavirus. It's kind of a more abstract risk, but as something to note, there could be more working from home as people kind of are going to get used to it, are already getting used to it. So what do a lot of people do when they go to work? Well, they stop on Starbucks. So that could impact them a little bit longer term, maybe 8 to 12 months from now. But I don't know if that's necessarily going to be that big a deal. But as I mentioned, they do have at-home brewing options like K-Cups and bag coffee. And then the other thing is reliance on global supply chains. So they have a lot of exposure to South America and some other parts of the world as well. So it's not like they're not able to necessarily control that as well. So that just increases their exposure to other labor markets. And then I just wanted to point out also in the mitigation section at the bottom bullet, I just put in their 2008 revenue versus the 2009 revenue drop. So which was our last major recession, obviously, it was a pretty big recession. So just obviously this impending recession is going to be very different than that. The different causes definitely have a different overall economic impact, but it's just a decent idea of their revenues did not drop that significantly from 2008 to 2009. So that's something to keep in mind. And that's part of the reason why we're really focused on Starbucks here. The other thing is on the ESG influence, Starbucks has supply chain partners that value good labor conditions. That's part of their cafe sustainable sourcing efforts. They actually go through and audit their suppliers yearly and just kind of make sure that all their guidelines are being followed, and they have pretty stringent guidelines, far and above most legal rules and laws. So and they ensure there's no child labor, because sometimes in third world countries like in South America where coffee is grown, there can be issues with child labor, employees not getting fair wages, that kind of thing, and Starbucks definitely takes steps to mitigate that. And then another ESG influence is just consumer preferences are shifting more towards being environmentally conscious. People are a lot more aware of their impact on the environment, and I think that Starbucks is doing good things with that. They're encouraging reusable cups and reducing straws.
Cam, do you want to continue with ESG integration?
Sure. All right. So specifically, we already talked about the industry and what their ESG material factors are, but I just kind of wanted to respond to each of those in the context of Starbucks. So as I mentioned multiple times now, I'm not going to go into too much more depth on it, the labor practices and material sourcing and all that stuff. Starbucks really uses this CAF sourcing strategy to kind of manage that. They have people that go out and, as I said, audit and make sure that things are all adding up there. In terms of labor practices, in addition to their supply chain management stuff with their labor in their supply chain, they're paying their workers through the coronavirus shutdown. They have college achievement plans through Arizona State University. So someone who's working a minimum wage job at Starbucks can actually get their college tuition paid for and get a degree through the online university at Arizona State University. So that's that's a very good labor practice in my view. for them. And then ecological impacts, I've talked about it multiple times, are going strawless, encouraging reusable cup use. And then customer welfare, that I kind of saw their employee bias training is actually helping that a lot, because that's really focused on their customers. They understand that, people have biases and that needs to be taken into account. So they're doing their best to mitigate that and serve customers fairly, as they should. And they're also focusing increasingly on nutrition, as Ben kind of mentioned before. They're still providing, they're still selling Frappuccinos, but there's less of a focus on that. They came out with cold brew a few years ago. I think they were one of the first coffee chains to do so. I don't remember fully, but that's a high margin item that is less bad for you, I guess. So, and they're also focusing on their fruity refresher drinks, if you're familiar with their menu items. And then in terms of third-party data, we looked at MSCI. We didn't have access to Bloomberg, obviously, so we couldn't get that disclosure up for you guys. But their MSCI rating is BBB, which doesn't jump off the page at you. But in terms of, I obviously downloaded the report and looked at it, and in terms of compared to their competitors, they're right in line with their competitors, or doing better than the rest of the block in terms of food and beverage. So they're ahead of the curve, despite not necessarily having an incredibly high score in the A's. And then in terms of mapping the SDGs of the UN, a lot of their kind of efforts focus on many different things, including no poverty. They're paying their workers in third world countries fair wages to kind of make sure they don't fall into poverty. I'm supposed to say good health and well-being. So obviously more of a focus on nutrition in terms of their products, focusing on quality education with their college achievement program, gender equality with their bias training, decent work and economic growth kind of goes back to their fair wages, and also providing that college achievement program. Reducing inequalities goes back to the employee bias training. And then responsible consumption and production kind of harkens back to their CAF sourcing, and then climate action, obviously, on their going strawless and encouraging reusable cups.
All right, so now into their evaluation. So when you compare Starbucks to their competitors, they're typically trading at a higher multiple than most of their competitors, specifically Dunkin' brands. While that does not necessarily say good things about its valuation, I actually think that shows more or less the confidence in the brand relative to Dunkin's and McDonald's. It's also important to note that they're not really comparable to any of their competitors in terms that are public, and we couldn't find any private deals to really find other ways of comparison. But McDonald's obviously is not just a coffee supplier, and then Nestle is a much larger producer. And then Dunkin' brands is different in that it's not people go to Dunkin' Donuts to get donuts and other sort of food items, where Starbucks is, although they sell food items, I wouldn't say that they're mainly known for their coffee, where Dunkin' is known for their donuts or other breakfast food. So I'd say that's all important to take note of when you're looking at this. And then I would also say that to pay attention to the return on assets, which is significantly higher than Dunkin's and other competitors. Their only kind of comparable company in that category is McDonald's, and that's probably due to McDonald's ability to sell a ton of items for fairly cheap. And then they also lead in sales, which is important, specific to lead in sales relative to Dunkin'. So now their DCF, which I was primarily concerned with. So as you can see, this year we projected, it doesn't say the growth rate, but it's negative 50% growth. So we expected a decrease in growth of 50%. I'm not sure that that's actually going to be hit, but I really have no idea where COVID's going to go. So I figured 50% is the worst case scenario. I actually was at Starbucks just before this, and the line was around the corner into the street through the drive-through. And I know that in China, they're reopening after only being closed for a month. So I don't necessarily think the hit to revenue is going to be that steep. But with that being said, I didn't want to like underestimate that and have the cash flows decrease, or sorry, have the cash flows be like overestimated. So I really tried to hit the growth hard. In which case you can still see that it'll be negative cash flow this year. And then after that, we had 75% growth based on like off of 50%. So 75% from 2020 to 2021. And then back to around 6% after that, which is where it's been trending the last couple of years. So despite the decrease we're going to see this year, I think that it will return to a pretty normal level. It is important to note that depreciation will stay the same because they depreciate in straight line based on their stores and not necessarily their revenue. So their depreciation expense will stay primarily the same regardless of how much volume they have. And then we also felt that their capital expenditures wouldn't decrease or increase significantly. If anything, they would stay around the same just because you have COVID-19 kind of slowing them down, but also the interest rates provide a good opportunity to invest. So they kind of, the situations balance each other out. And then the net working capital is found through percentage of revenue average. And so kind of to bring it to the price target, the base case was $90.95, which is 35% upside. That's assuming all these conditions right here. And then the bull case, which we figured would be maybe if cash flows were -30 instead of -50% this year, that would lead to around $115.70, which is 45% upside. Or sorry, if it decreased to 15%. And then bear case is if it decreased to 65%, recovery is 50%. So that's like this COVID or coronavirus lasts for months and really kind of takes away most of this business. Okay.
And then for the conclusion, just kind of wrapping up some of the things we talked about so far. Just reiterating our buy rating at $65 for the price target, 1 year price target of $90.95. Some of their, oh shoot, I guess I forgot to delete the presets here. Their brand name will definitely benefit them in an impending recession. People are going to flock to brands that they know. They're not going to be necessarily trying new high-end coffee brands. They're going to, go to the Starbucks, go to the Dunkin' Donuts, go to the McDonald's for their coffee that they know and love. And then they're capitalizing on those consumer trends, such as that high-end coffee. They're opening high-end coffee brands, or sorry, not brands, stores in high-traffic urban areas, which may prove not so good during a recession, but at least it's in an urban area and there's only a few of those stores, so it's a pretty low risk, and it's something new. So someone who's been consuming Starbucks for 10 plus years was like, oh, I might as well try this if they're in Boston, they're in New York, or one of the other major cities that they've opened up one of these stores. And they're also mitigating those oversaturation risks, as I mentioned before. And I've read some stuff on China, and they're recovering a lot quicker economically than people expected from the coronavirus. There's still a lot of uncertainty there. There could be a second wave of the virus. And if the rest of the world's not buying their manufacturing goods, then their economy may not actually be able to recover as quickly. But it is clearly recovering quicker than the rest of the world. And as China expands there, that may help mitigate losses elsewhere. And they are definitely a big ESG focused company in terms of reducing single-use products and ensuring responsible sourcing.
Thank you guys.
Thank you. Any questions?
So the majority of your thing, good job first off. Thanks for doing this. The majority of your pitch and model kind of revolves around risk mitigation and why they won't be hit so hard, but do you see any room for growth or why they would actually improve over this time, or is it more of just a they won't go down type of a idea?
So I think their growth is definitely internationally. As Cam mentioned, they're pretty oversaturated in the United States. I mean, there's a Starbucks on every corner, which obviously leads to their market share. But I think internationally is the place where they're going to grow their revenue the most, in terms of I don't think people who in the United States are all of a sudden just going to flock to Starbucks more than usual. but I do think China could adopt Starbucks, which could definitely lead to really high growth patterns. But I tend to think that with coronavirus, we're going to see it Corona kind of downplay that like potential growth, obviously, between raised costs of like paying their employees for 30 days and just like people not going to stores and the margins being lower. So I think in the long term, the growth would be international and specifically China.
And the other thing is, I think with China, the big focus is going to be tea. And what they've done in the U.S. and elsewhere is they've closed all remaining tea. They own Teavana, if you're familiar with that. It's basically just a tea shop. And those margins are a lot higher. They've closed all Teavana stores to try and integrate it back into the Starbucks, or not back into, but integrate it into the Starbucks stores themselves, which should provide some growth in the U.S. as well as internationally, because there's obviously a lot more traffic in those Starbucks stores. So and then they're able to sell those higher margin tea products, both in the U.S. and then also in the Chinese market, where that's a major market in China, obviously tea over coffee. So they should be able that should be definitely a solid area of growth for them. But we do see the risk mitigation as a more important aspect of the pitch at this time.
Yeah, great job, guys. Just one other quick question too. You talked a lot about like the supply chain and how dependent they are on their supply chain. Like, how hard is, or how disruptive, I guess, is the coronavirus situation going to be to them getting like the supplies for their coffee and things like that from South America right now?
Yeah, so it hasn't been very disruptive, partially because South America has really not been hit that badly by the coronavirus. So, borders not being closed, that kind of thing. It's not like a China situation. And I listened to a couple recent calls with their CEO, and he didn't mention anything regarding issues with supply chain. And he was pressed on that. So they, asking about risks in terms of coronavirus, and he didn't mention the supply chain, and I couldn't really find anything specifically on that. So it shouldn't be that big of an issue unless the possibility of coronavirus spreading drastically in South America, where most of their coffee is grown.
I have a quick question on their MSCI rating of BBB. Did you guys see within the report what were kind of the underlying metrics driving that BBB rating? Because that kind of hits right in the middle on the MSCI scale from AAA to
Yeah. Specifically, the supply chain management was the leading metric, or like their labor standards specifically. Cam, are you pulling up the?
Yeah, I'm trying to pull it up.
Okay. And then in terms of like its comparison, Cam mentioned in consumers, there's like 3 single A's, I believe, in the entire sector. So BBB was kind of, I don't want to say the standard for like food and restaurants, but that seemed to be the highest rating out of many of the companies that were listed. If that makes sense. Cam can further elaborate if you find it.
Yeah, I honestly don't fully remember what the underlying drivers were, Yasmin. Sorry about that. I'm gonna try and pull it up now and see if I can quickly find it.
Yeah, no worries. I was just curious.
I believe the other driver, and I could be wrong, but if I remember correctly, the other driver was the governance factor, and specifically their trainings, their anti-bias trainings, and their promotion of like basically quality workers or baristas. And I'm trying to think of where they ranked that, but that was, I believe, on the top 2.
So a lot of their basically detraction from achieving a better score in the A's was with their product safety and quality. They've had some pretty, to be honest with you, pretty based on what I remember from reading yesterday, they've had some pretty minor issues with that kind of stuff. But I guess that's pretty weighted pretty heavily in the MSCI rating. So that's definitely their major detractor. But their supply chain, labor, nutrition and health, carbon emissions, that stuff really helped them achieve a decent score. But like we said, they're pretty they're above and beyond the average in terms of food and beverage and restaurants.
All right. Sounds good. Thank you guys again for the pitch. Does anybody else have any answers to that question? I'm gonna actually look at the MSCI report more in detail myself as well. Does anybody else have any last minute questions? I think we have time for maybe one more if there is any. If not, I'm gonna pass it on to the next pitch for today. Okay, thanks again, guys, and good job on your first pitch. Now, Mirage, feel free to share your screen, and you and Haley can take it away.
Okay, sounds good. You guys see it?
Yep.
Okay, cool.
Yep.
Why did it get stuck? Sorry, I don't know why.
Sometimes it's easiest if you just put it in a new tab and then
Okay.
share that. Or yeah, this is perfectly fine. Yeah.
All right. So it should be good now. So yeah, we're gonna go through. So we did our pitch on NextEra Energy. So I did this with Haley. So we're gonna go through the investment thesis, industry overview, company analysis, ESG integration, and our valuation. So with their investment thesis, NextEra Energy's competitive positioning as a renewable energy leader in the United States and continuously growing its project portfolio creates a significant potential for growth. This growth potential makes NextEra Energy a strong buy based on the industry trends and demand for clean energy. So we recommend to buy NextEra Energy at its current price of $241. We have a price target of 300, and they have a market cap of 120 billion. Some of the ESG factors that we looked at is that they're the leader in renewable energy in the United States. They're the largest generators of wind and solar in the world. A couple other catalysts are that they're industry leaders demanding. There's an increasing demand for renewable energy and technological innovation. And some of the risks that we saw were long-term effects of the coronavirus on the market and oil prices dropping.
All right, so if we go into kind of our industry outlook, the renewable energy industry as a whole is what we looked into. So there's a lot of increased government funding, not only in the US, but around the world, just kind of to support, to reach climate goals, to kind of help people with the R&D, to help people get these wind farms and these solar farms set up. There's tons of technological innovation. So this innovation is kind of just bettering solar modules, bettering wind, try to generate more energy from smaller spaces, kind of things, and to also decrease the cost. And there's a large increase in consumer demand and collaboration. So consumers as a whole are kind of becoming more environmentally conscious, kind of asking what they can do. Then there's also this whole group of people that are trying to put solar panels and stuff on their houses to put the energy back in the grid and gain from that. And then renewable energy is now making up over 23% of the entire US's power generation as of like a month ago, which is a huge amount. That's more than coal. Natural gas is still the leader there, but kind of pretty important to recognize that this is the direction people are heading. Material factors that are more ESG related are life cycle management and then material sourcing and efficiency. These two can kind of go together. So we're just kind of seeing that the kind of big trick in doing well in renewable energy is managing how much money you're going to put in your project, how long it is before you're actually going to get a return on investment, and how much you actually are going to need to continue investing as it goes forward, which just kind of super important to renewable energy, whether you're investing in wind, solar, or even hydropower. And then material sourcing and efficiency. So this is basically saying, are the materials being used reusable and last the duration of a product? So this is kind of to keep the depreciation costs down, to make sure that once you do put money into a project, once you invest in a project, that the company is actually able to keep to ensure that the project is like a long-term good investment. And then also, are we kind of not taking step backs ESG wise, because we don't want to use products that aren't essentially ESG friendly to do something that kind of is super environmentally conscious. And then, so future growth for the renewable energy industry. So solar and wind are both kind of huge things that are looking to grow. If you look at the graph on the right, there's essentially an increased generation by energy source. It's not just the amount of energy that renewables is increasing, but also the share of the generation is increasing. So I mentioned that 23% renewable energy in the US, that is expected to grow by a ton. The share generation graph is a little bit hard to read because with that 23%, because non-hydro renewable and hydropower are combined when we're looking at the total renewable. Next to ERA, the company we're looking at does wind and solar. And then there's also a huge desire to meet sustainable development goals. These goals do require rapid growth renewable energy projects. This is not just like for us, next ERA, it's kind of like as the US as a whole. If we're going to meet any goals that we have, if the states are going to meet any goals, we do need to kind of invest in renewable. And then kind of two big things, if you look at the bottom graph, cost of renewable energy has drastically decreased. This is coinciding directly with the increase in consumer demand. So as people demand more solar and wind, we are honestly able to provide it for a much cheaper cost, installation wise and as a whole. And the amount that people are requesting is huge. And then grid operators are increasingly becoming more skilled in how they can integrate renewable energy into their power grids. So essentially what this means is that if a community is trying to reach new goals, that solar and renewable energy companies are getting a lot better at kind of integrating and providing renewable energy to these grids.
So for a company overview, so NextEra Energy have ticker symbol NEE. They were founded in 1984. They own a lot of subsidiaries, the major ones including Florida Power and Light, NextEra Energy Resources, NextEra Energy Partners, Gulf Power Company, and NextEra Energy Services. With all affiliated entities, NEE generates the largest renewable energy from wind and sun worldwide. They had a name change in 2010 from Florida Power and Light to NextEra, and they changed their ticker symbol as well. Their CEO is James L. Robo, who got his bachelor's from Harvard and an MBA in '88 from Harvard Business School, and he was named the CEO in 2012. So their ESG efforts mainly are new emission reduction goals cut by 67%, and they also started a volunteer program called Power to Care. One of the biggest things that I looked at was how much they reduced their dependency on foreign oil. So they have a 98% decrease since 2001, which I thought was really impressive. And if you see from their 1 year performance, they're just off their high of $283 that they're trading at right now, around 246 to 247. So I think they're doing pretty well still. They didn't see as big of a drop off as some other companies, and they're still they're up 24% this year, and before the coronavirus crash, they were up 45%.
So some risks of mitigation. Tariffs and solar modules is kind of a huge one as the trade war kind of goes on and things are still imbalanced with that. It is hard to kind of start new projects if the tariffs on solar modules are super expensive. And what NextEra does is a lot of acquisition, so they kind of buy projects that have already been created. And if there are no new products to buy, they can't grow, which is kind of a huge risk to them. And then also the phase out of renewable tax credits. So this is basically, as renewable energy grows, people are kind of looking to get these tax credits. And as the tax credits are kind of phased out because more people have renewable energy and there's not really a point in doing it anymore, next era will kind of hurt with that. And then environmental compliance is just kind of a huge risk for all companies, but just ensuring that they are. And then the safety and health of workers, again, for all companies, especially ones with big wind farms and solar fields, that have kind of large acquisitions of plants, kind of managing everything and ensuring the safety and health of all the workers. And then I made a separate section for coronavirus just to kind of look at it. I'll touch on the coronavirus stuff after I go through mitigation and ESG influence for that stuff. So mitigation, they have long-term contracts with their suppliers and consistent relationships with their manufacturing companies. So they're basically kind of trying to keep solid things going. They aren't kind of at a stopping point right now. They are still going to be acquiring, they're still going to be ensuring that things continue to grow. They do have the ability that even with the phase out of renewable tax credits, they will be able to afford it because of their large market cap. And then they also ensure all compliance with federal, state, and local policies. They have boards that do this, and they also do daily site inspections. This touches exactly on their safety and health of workers. This is kind of just because they did have some issues, I think, in 2015 with the safety of one of their workers, and they've totally upped their kind of health and safety requirements. Then ESG-wise, they go above and beyond these environmental compliance requirements. So all the regulations that are put, they have their own standards and they're way above it, but they do look into their thing, into each county they're in, into each city they're in. They also aim to have no environmental events going forward, which is a huge thing environmental wise. They have an entire corporate environmental governance council, and their code of ethics council, and their code of ethics and council are published very openly. So this covers both the safety and health and environmental compliance. And then coronavirus as a whole, so I don't know if anyone's gotten gas recently. It's incredibly cheap. Decrease in oil prices as a whole leads to the decrease in the price of natural gas, which means that the demand will increase for that, and people will be kind of relying on natural gas and more stuff like that to get energy. So with that kind of can lead to a global demand forecast decreasing. So in the obviously in homes, the energy needs are going to increase with coronavirus and remote working, but I don't know, with people not in their office buildings and stuff like that, it's going to kind of take a huge toll on the amount of energy that is needed. And then a supply of equipment put on pause is a huge risk. So what they're doing, they are suspending electrical disconnections. This is kind of a great thing. So in Florida and all over, when they have more of a hand in what they can require, they're basically saying if your electricity is going to get disconnected because you can't pay, we're going to kind of put off your bill and we won't disconnect you until kind of after things have settled down. And then they're also helping decrease people's bills. They're providing a bunch of energy savings tips to people just to kind of make sure that people are still paying their bills. And then they had this entire care to share program that helps neighbors and keeps everyone paying their bills, so they aren't going to get hit that bad as things go forward.
So in terms of their ESG analysis, so for their material factors, we highlighted their efforts in mitigating harm to wildlife. So one of the things that they do before they select an acquisition is they make sure that it wasn't built on any wildlife reservations. They're making sure that the wildlife wasn't affected that drastically by wind farms or solar farms that they're creating. The next thing that they did was they were hiring more women and different ethnic groups, which is really important. They wanted to up the percentage of women in their workforce as well as diversify their workforce. And I know that they're working on improving their board diversity as well. They're dedicated to reducing CO2 via clean tech. One of the best ways to combat climate change is reducing your CO2 emissions, and by pulling out a lot of their money in the coal and fossil fuel industry has allowed them to really reinvest their money into wind and solar. And as Haley said, health and safety is one of their top priorities. They're always looking to improve safety protocol after their one small incident And then for third-party data, so we weren't able to get the Bloomberg disclosure score, but for MSCI, they're one of 7%, like the 7% of companies that MSCI reports on. They have a AAA rating. One of the MSCI Global Alternative Energy top 10 constituents, S&P Global ESG Evaluation Score of 86, and the CSR Hub high of 81. And in terms of their SDGs, they follow number 7, cleaner, affordable energy, 8, decent work and economic growth, industry, innovation, and infrastructure, and sustainable cities and communities. So one of the biggest things, but I think that they're doing really well on is 7 and 9. Right now, there isn't enough infrastructure built to reach our renewable energy goals. So what they're doing is reinvesting their money into projects that are already built and doing well. So they're increasing money to the people that are developing the projects. So more projects are being built. So they're buying out really good investments, which is helping their project portfolio.
So if we look at kind of comparable companies, so these 4 companies are all renewable energy companies. They are all a lot smaller than NextEra. There isn't really a good company to actually compare NextEra to that is of the similar size, but NextEra's market capitalization is 120.6 billion, making the investment in NextEra a lot less risky. So kind of with the current climate right now, they are one of few companies that we can almost guarantee that they're going to be strong enough to weather the current economic downturn and not actually get hit that bad. A lot of these smaller companies might end up having to merge or get bought and stuff like that. And so there isn't really a risk there with NextEra, which is kind of just a really good thing to notice going into it. And then as NextEra's acquisitions continue to grow, they have the ability to spend a lot more than any of its competitors. So for the next 5, 10, 15 years, for NextEra, we can see their kind of capital expenditure staying the same, but their capital expenditure amount is huge right now, which is why if we look at kind of some of the data, the ratios don't seem as strong, but it's just because they're able to spend more money to kind of grow their company, and they are most likely going to be able to continue to grow. With some of these companies, they don't have as solid sale numbers, like going back a few years and stuff like that. A solid EBIT either, which is just kind of a good thing to note for NextEra.
So this was our DCF model for them. So one of the things that you guys probably notice is that they do spend a lot of money on CapEx, which kind of threw off our model a lot because as of right now, they're planning to invest 50 to 55 billion through 2002. And after that, we're not sure what their CapEx is going to look like. So we held it pretty constant. So one of the things that I personally thought is that since they are an energy company and they do most of their growth through acquisition, CapEx is always going to be one of their main drivers in terms of spending their money. So one of the things that I wanted to make sure going forward is that the things that they're spending money on and the projects that they're spending money on are strong renewable energy, wind and solar plants, mostly offshore wind. They have most of their plants right now in Florida, New York, and in California. So I'd like to see some money spent on wind projects in the Midwest, since there is a lot of availability there, and I think it's a really strong market for them to grow their company.
So if we look at our price targets, our base case, the $300. So this is kind of based off of the increasing demand for renewable energy. We're assuming it remains constant in this case, and then companies and individual consumers are continuing to seek renewable energy as their main source of power. I don't think this is a super kind of crazy estimate for what's going to happen. NextEra is a pretty solid company with this stuff. Bull case, kind of a crazy case. This is, I don't know, kind of a far reach. We basically said kind of new policies require power companies to increase the availability of renewable energy. So this would come with kind of huge political change coming up, or coronavirus kind of calming down immediately and actually the oil prices increasing. And then a bear case. So basically low cash balances decrease NextEra's ability to acquire new projects, kind of halting their growth because that's where most of the growth comes from. But as Mirage said, that's also not super likely because there is a ton of availability to, in the Midwest and even heading more west than that. Just kind of And then also kind of a potential continuous economic downturn spurns investors from investing in NextEra just because of coronavirus.
So in conclusion, we found that NextEra is one of only 7 comparable companies rated AAA by MSCI for ESG. So I think it would be a strong start for our portfolio to have a really good ESG company. Along with their 20.5% upside, they also offer annual dividends around 2.4%, which would add additional value to our portfolio. And I think clean energy is one of the strongest ways to combat climate change. And so having a strong environmental company step up and say that they want to reduce CO2 emissions as their main goal, I think is really important. And I think they're just doing a lot of innovative tactics to kind of generate more renewable energy in the Southeast. And I'm looking to I'm hoping that they bring a lot of their projects to the Midwest where there is a lot of availability. And it's something that they have mentioned previously in some of their calls that they're looking at a lot more wind projects around that area. That's it. So if anybody has any questions.
So great job. That was a great company to pick. How did you guys deal with in your model the idea that we're like in a low interest rate environment, but we're also going into a recession? And some people can look at low interest rate environments for a great area to do investment spending, such as like huge capex, like this company would be doing with solar panels. But also going into a recession, usually discretionary spending would go down. And sometimes people see things that are ESG forward, thinking kind of in a discretionary spending mindset. So how did you guys balance those two frameworks out in modeling out this company?
We didn't really know how to incorporate it, but I know what you're saying. They kind of like committed to about 50 to 55 billion in capex through 2022. So we weren't sure if they're going to increase or decrease that amount going forward. But I do think that if there are more projects being available to be bought out, I think they've kind of shown that they're willing to spend that money on projects that they deem worthy enough to be put in their project portfolio, because it's been expanding year after year by billions of dollars. So I think that they're okay with kind of opening that up and saying if they find projects that are good value for them right now, even in an economic downturn, they're willing to kind of spare that cost and just go ahead and do it, because they see that clean tech is moving forward and a lot more people are demanding renewably sourced energy.
We also talked about, I know Raj mentioned to me, kind of as people restructure their portfolios, it kind of ESG forward companies and companies that are kind of pretty solid investments like NextEra are a great place to go. So just kind of keeping that in mind, we went forward.
Does anyone else have any questions? Okay. So no one else has any questions. That's kind of it. And we'll send out the voting stuff later today, right?
So if nobody has any other questions for them, what we're going to do is we're just going to send over the recording for everyone. We're going to send over the pitch decks and then also the voting. It's going to be a password. Sasha, what's the password?
Sustainability.
On brand.
So one other thing too, and this is just for all of the analysts moving forward, for the contact us page, if you guys could just put your contact information, that'd be great too, so that like when we send it out to general body members, if they want to reach out to you guys, like they have like an easier way to reach you, that would be good as well.
Oh, good point. Do that. So if there's like no other questions, I hope everybody's doing safe or is safe and healthy at home. I know this is not ideal for any of us, but like hoping the best for everyone. And if you guys need anything, you guys can obviously reach out to anybody on the executive board, and hopefully you guys feel comfortable reaching out to other analysts in your kind of like analyst class right now. As for other things, we're just also still hiring. So if you have anybody that you think will be great as an analyst next year, we have a few seniors graduating, and obviously executive board positions are going to be opening up. So feel free to pass along the application, and then encouraging anyone to apply for executive board roles. We're introducing a few new ones. So if you are interested in any of them, feel free to just text us and just ask us about our role. But yeah, so deadlines have been extended for that. And also requirements are just preferred right now. I know that there were questions around that. We're kind of just setting the precedent for years to come. But yeah, don't let those shy away from you applying.
And guys, I really can't stress enough like how like great that kind of leadership role is to have on like a resume. I mean, that's come up in literally every job interview I've had for like the past like 12 months now. So, you know, it's definitely a really great opportunity for you guys to get leadership experience and to really like refine your knowledge of the industry. And I mean, it's applicable to a lot of different things, like, you know, all the fundamental analysis and stuff that you're doing right now, like that applies to like investment banking, it applies to asset management, it applies to corporate finance. Like what you guys are doing it's awesome stuff, and it's really going to be beneficial to you. So I would definitely encourage you to pursue like additional leadership opportunities within the organization as well.
Thanks, Steve. All right, so I'm just going to end the meeting now and we'll follow up later. But hope everybody has a good rest of their week.
You too, Yasmin.
Bye.
Thanks, guys.
Bye.
Thanks.